Well, good afternoon and welcome to HYROX's weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of HYROX, is also with us, as is our financial planning professional and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. So as we do each week, let's start with a quick review of our themes for 2017. I will say that I've amended some of the wording ever so slightly, but the themes remain the ones that we set about at the beginning of the year. We think that our strategy of having a tactical perspective to investing is even more important this year because of the even greater levels of uncertainty imposed on us by a host of developing factors. Inflationary expectations have been rising, and while other central banks are more cautious at the moment, the U.S. Federal Reserve raised rates by 0.25% on March the 15th. It is expected that earnings will grow at an approximate rate of 9.9% in 2017, which has been lowered from a rate of 11.5% at the beginning of the year. However, valuations are at 14-plus-year highs, putting stock prices about 20% above the prices of the 10-year average valuation for the current level of expected earnings. Now, earnings thus need to increase by an additional 20%, or stock prices need to come down to get back to the average. Historically, everything always returns to the average. The Trump agenda appears to be running into political hurdles. Brexit is finally being initiated. The Dutch said no to populism, and French elections are upcoming in April and May. Meanwhile, protectionism concerns are rising. One of the reasons that we desire a more tactical approach to investing over the old school buy and hold strategies is the changing nature of long-held correlations between U.S. stocks and bonds in the U.S. and in Canada as well. Paul, did you wish to elaborate on what these charts show us, or you?
Sure. Well, the one you have up there is actually probably a pretty good one. About a month ago, I should go back and highlight that basically what this chart shows is the green line is the 10-year Government of Canada bond, and the white line is the TSX index, the equity index. And typically traditionally what happens is they both would move in tandem, i.e. when stocks rise, so would bond yields. But what we've seen, as you can see on this chart, is the correlation has broken down. It broke down in September and lasted through the fall for a couple months. And when we saw that correlation start breaking down, in fact, we sold some of our 10 and 30-year Government of Canada bonds, which turned out to be kind of fortuitous sales because, as you can see, that green line, the 10-year yield, rose, which meant prices went down. Then about a month ago, we added back some of our 10-year Government of Canada bonds, and as you can see lately, the 10-year Government of Canada yield has dropped and prices have gone up. So what we want to do is, the reason why we look at this chart is when the correlation is normal, we feel comfortable holding Government of Canada bonds as a hedge against our overall portfolio, as part of our diversified portfolio. But if it starts going off kilter and it moves away from being the strong correlation that's been historically over many years, then we need to either buy or sell accordingly, which is what we've been doing. So right now we're kind of still in a strong correlation, a reasonably strong correlation. As you can see, we've come off the peak from about a month ago or so, but it's still a pretty strong correlation. So we remain long some of these government bonds. So it's a bit complicated, but we are looking at this, and there is some method to the madness.
But it's also impactful in so far as the old school of buy and hold a certain percentage of equities and a certain percent of bonds breaks down from time to time. And one of the things that you're doing is taking advantage of when those things break down, adjusting portfolios in order so that they don't get caught in sort of that trap, right?
Yeah, absolutely. I mean, I think I wrote a blog on it a couple months ago, but you know, we have a model. We have 3 models: fixed income, global equities, and tactical. But we are tactical across all 3 of those models, and including, you know, Government of Canada bonds. You and I both traded them for a living for many years, and quite frankly, we still do. So that's exactly what we're doing, being tactical in all parts of our portfolios.
Excellent. Well, thanks for that, Paul. And something we've also been looking at and bringing up from time to time, of course, is opportunity. And as opportunity arises, we do want to be tactical about it. And we anticipated that we would get better prices in the markets. And it appears that we are starting to see and get closer to some opportunity potential. So I just wanted to also show that there are numbers of factors that we take into consideration. Well, the benchmark equity index that we use for comparison has returned about 16.5% from this time last year, but only just a little under 5% annualized since this date 2 years ago. So there's some emphasis on the volatility that equity markets have been through over this period. Meanwhile, the benchmark bond index has barely had any positive return over the last couple of years, leaving investors with that fixed greater weighting of bonds with very little to show for their investments there. Well, each week I look at how short-term and longer-term returns have progressed in the benchmark ETFs that we use for comparison to client portfolio performance, so we can continue to monitor our clients' progress. Each client will likely have different starting points and may have different allocation weightings. So for newer clients, there may be some differences in their personal portfolio returns, especially in the short term. So we want to focus on more longer term returns, because that, in the end, is how we will be judged, achieving our clients' long-term goals. And just another note, today is March 28th, so there's only 2 more days left in the quarter. So each of our clients will receive, over the next week and a half or 2, will receive an updated summary of their portfolio performance, as well as this chart to make portfolio comparisons against. And as we look at a longer-term HIROC client, you can see the 1-year performance is slightly behind the 1-year benchmark, which highlights how our client portfolios have a lot less volatility than the benchmark, because we've seen the benchmark portfolio moving up and down considerably over the last couple of months. Meanwhile, the client portfolio has remained relatively benign. But again, our focus is on the long term, and the performance of about 4.5 years speaks pretty much for itself, well ahead of the long-term benchmark by close to 3%. And that is the success that we bring, and of course, that is the success that our clients get. And as you all know by now, historical returns are no guarantee of future returns, but at HIROC, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis, so that we can ensure that our long-term goals are in line with your portfolio strategy, and our forecasts for your net worth into the future are up to date and heading in the right direction. We are watching the inflation story closely this year, As all central banks have a mandate to maintain price stability, we're focusing on inflation as a key to determine if and when interest rate policy may change. And while total inflation data has been rising on a global scale recently, core inflation continues to remain relatively subdued, although it is inching higher. Most recently, the Bank of Japan, Bank of England, and European Central Bank have kept rates steady and monetary policy unchanged. The Federal Reserve raised rates on March 15th, as I alluded to earlier. With the uncertainty surrounding the French election, which is coming in later this month, and the second round in early May, it is not likely that the European Central Bank will make any significant adjustments to monetary policy until that dust has settled. And I'll talk about that issue a little later in more detail a little later in the program. One of the reasons for a higher total consumer price index has been the steady improvement in oil prices. Oil prices dropped by about 10% a few weeks ago, which may reduce the total inflation outlook going forward. This volatility is why central banks like to take out the energy component from their inflation calculations to get a better read on core inflation. Oil prices are little changed over the last week. And commodity prices are generally lower with oil prices, but again, little changed over the last week. Well, as I mentioned in my blog this morning, first quarter GDP in the U.S. is tracking at levels that are well below what was expected at the outset of this year. And earlier today, the Conference Board announced that U.S. consumer confidence had jumped in March to its highest level since 2000. But if we look back through history, consumer confidence has peaked just slightly before each U.S. recession. So the question is this the peak? Well, we think it's too soon to tell, but it is another metric that we will have to keep our eyes on. Interestingly, the survey was taken prior to the failure of Trump's Healthcare Act. Well, in conjunction with the shape of the U.S. yield curve, a flattening yield curve where 2-year bond yields in gold rise to intersect with 10 and 30-year bond yields, which are in green and purple, and has historically indicated that a recession will follow soon thereafter. If the Fed raises interest rates enough, the yield curve could flatten further, pushing the U.S. economy closer to potential recession. On the other hand, if the U.S. economy unexpectedly stalls, and certainly we're seeing a stalling U.S. economy in the first quarter, falling 10 and 30-year bonds could also be a catalyst for yield curve flattening. And over the course of the last week, we have definitely seen some flattening of the U.S. yield curve, and especially so since the Fed raised rates on March the 15th. The yield curve from 2 years to 10 years has narrowed or flattened by about 0.25%. In Canada, the Canadian yield curve followed the U.S. yield curve flatter. The Bank of Canada has its monetary policy on hold until it gets a better read on U.S. fiscal policy and the issues surrounding trade with the United States. Last Wednesday, the 2017 Canadian budget was announced. The Trudeau government left taxes alone, but it helped caregivers. It increased our cost of adult beverages, and it set aside more money to police tax avoiders and evaders. Generally not a significant issue for family wealth management. However, we know that there is discussion surrounding capital gains taxes and a potential to tax the wealthy with an increase in the capital gains inclusion rate. This means that taking capital gains over the course of the next year may be a prudent strategy, and we are happy to discuss this on an individual basis with you when we sit down for your next semi-annual wealth forecast and review. On the debt watch, we have been pointing out the risks of record amounts of global debt with rising interest rates. This puts increased pressure on servicing that debt. In margin debt, the money that investors borrow to buy stocks is at record highs and is now more expensive. When the Fed does remove liquidity from the system, as they do when they raise interest rates, financial institutions have a choice: borrow at higher rates or sell assets to increase their cash flow needs. If they sell assets, they will likely sell the most expensive ones. They have been selling expensive equities lately, well, until today, that is. However, interestingly enough, it is expected that the Fed will raise rates at least 2 more times this year. And that being the case, there will be continual draw on liquidity. So we have to see what implications that will have as well for equity prices, being that they are an expensive asset right now. And speaking of which, let's talk about the value of equity markets. Expected earnings, as I mentioned earlier, for 2017 have been reduced from 11.5% year-over-year growth at the beginning of the year to 9.9% now. For the first quarter of 2017, earlier expectations were for a 12.5% year-over-year increase in earnings. That has been lowered to 9.1%. However, stock prices continue to rise, have continued to rise, and looking forward, prices continue to outpace expected earnings. With lower earnings expectations and higher prices, the price-to-earnings ratio has jumped to about 17.5 times, close to its highest level in 14 years, as I mentioned earlier, while the 10-year average is at 13.9 times. And as I was saying, this means that earnings either have to grow by an additional 20% more than they are currently expected to bring the ratio back to its 10-year average, or the S&P 500 needs to correct by 20%, or perhaps a combination of the two. At the moment, we don't like what this represents as far as risk for our clients. Another of our metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were back at the time of the dot-com bubble. And interestingly, as I mentioned last week, since 2008, asset prices that are in blue, and you can see the different asset classes on the left, they have jumped significantly and more so than any of the economic growth indicators that are in pink. That tells us that something is definitely out of sync in the economic situation at the moment. Retail investors have been piling into stocks with record flows into ETFs and mutual funds over the course of the last 3 months. At the same time, corporate insiders have been selling. So that should give us some insight on what corporate insiders think. And that could very well spell the peak in the cycle as emotions have been running rather high. Well, let's turn to the geopolitical front. Until lately, volatility on stock markets had been falling, while the uncertainty index on global economic policy had risen close to new highs. Now, President Donald Trump and Republican leaders enter their next big battle, facing stubborn opposition in both parties that increases Republicans' worries that they will need more Democratic support than previously expected to avert a government shutdown by the end of April. It is a sign of the new reality in Washington after Mr. Trump and House Speaker Paul Ryan failed to persuade the House's most conservative Republicans, as well as centrists, to back a bill to replace the Affordable Care Act, also known as Obamacare. The failure derailed the Republican leadership, and the new administration's top legislative priority has put unexpected questions before both parties about their paths forward. For Republican leaders, the main challenge is the House Freedom Caucus, an alliance of the most conservative Republicans who successfully defied the White House to sink the health bill. Now, the most immediate test comes at the end of April, when the government's current funding expires. Lawmakers have only 12 legislative workdays before April 28th, the date by which they will need to pass a new spending bill or trigger a partial government shutdown. More distantly, Congress must approve an increase in the nation's debt limit, likely by this fall, and then fund the government for fiscal 2018, which begins in October. Apart from the must-pass legislation, Republicans still have other big-ticket items they hope to finish this year, including an overhaul of the tax code, which is unlikely to get much Democratic support. That has been a top priority of Mr. Ryan, the former House Ways and Means Committee chairman. But on Monday, the White House said it planned to take the lead. On the Brexit front, tomorrow the Prime Minister will officially tell the EU's other 27 members that the UK wants to pull out, just over 9 months after the British public backed withdrawal by a margin of 51.9% to 48.1% in a referendum. By triggering Article 50 of the 2009 Lisbon Treaty, Mrs. May will set in motion a 2-year process in which the terms of exit will be negotiated. Unless both sides agree to extend the deadline for talks, the UK will leave on March 29th, 2019. The Prime Minister said her goal was a deep and special partnership with the European Union after Brexit. Well, in France, centrist Emmanuel Macron would apparently trounce far-right leader Marine Le Pen in France's presidential election if, as seems increasingly likely, the two face off in the second and final round of the contest on May the 7th. Now, that was from a poll on today. The Ipsos Reid poll was the latest of many to show Macron and Le Pen 6 or 7 percentage points ahead of the former favorite Francois Fillon, who has been engulfed by a special scandal involving his British wife, Penelope, and 2 of his children. The poll conducted on Sunday and Monday showed Le Pen and Macron respectively securing 25 and 24% of the first round votes, with transferred votes from eliminated candidates ensuring a resounding victory for Macron in the final two-way playoff. So here at High Rock, with all the upheaval happening around us, we continue to monitor event risk, which we think is high, and price valuation, which we also think is too high, and we will add or reduce holdings in our models as opportunity presents itself. We will also maintain our disciplined approach to our strategies with skill, competence, and continued deep levels of research, making our tactical approach add value and reduce risk so as to give us all the best possible risk-adjusted returns.
Hey, Scott, could I just give you an update on the tactical side?
Absolutely, please.
So we actually have been adding a little bit. Well, actually, I'll go back. Last year, we made most of our energy bet in some high-yield energy bonds, Canadian high-yield energy bonds. We had a couple equities in the energy space that did quite well, but the large portion of our energy exposure was through lower risk high-yield energy bonds compared to the equities. That trade is largely played out, and I'll give you an example. We bought bonds, a year ago, or about a year ago, anywhere from 10% to 20% cash yields on these high-yield energy bonds, and we've been taken out of some. I mentioned last week we've been taken out of a couple because the bonds were called from us at par, or 100 cents on the dollar. Now, new issue bonds that are coming with a coupon or a cash yield of 6.5%, now's not the time to be doing that, but the opportunity is really starting to develop in these the underlying stocks of these energy companies. So I'll give you some examples here. Oil is arguably in the past 3 weeks off about 8 or 10%, and these high-yield energy bonds over the year-to-date, these energy company stocks are off, roughly 40% in general. So I'm not adding to any high-yield energy bonds here at 6.5 type yields, but I am starting to buy some energy stocks. I think that is a much better risk reward or skew. So in fact, we just added to 2 names today that will show up in our portfolios tomorrow. So that's one addition here in the tactical space that I'm focusing on.
Excellent. Thanks for that, Paul. It's a great update. And just as a clarification, I know it's just a terminology, but we really don't bet on the market. We actually do research to find value, and when we find value, we make an investment, right?
Did I say bet? That's my old trader talk coming out, but absolutely, these are well-researched companies that I know.
I hear you. Anyway, just a little bit of levity for our listeners. Anyway, as always, we do want to thank all our listeners for taking time out of your busy schedules to tune in. If you have any questions or concerns, we certainly want to hear from you, so please feel free to email them to us. We will be back with our next update next Tuesday. But until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great rest of the week. See you next Tuesday.